to the second in our series of webinars for solicitors. Some of you may have joined our first edition when Rachel Pierce was talking about property and SDLT. If those subjects are of interest, you can still access that webinar via our website. But today we're thinking about you and your personal taxation affairs as solicitors. And Tom Reed and I are going to be talking about how you can optimise your tax position from optimise your tax and financial position more widely. Next slide, please, Rach. So I'm going to be kicking off by talking about some personal tax optimization techniques that you might find useful. Just to mention, of course, we will have some time for some questions towards the end. If you want to put your questions in the chat box, then Tom and I'll do our best to answer those as we go through, or perhaps we can cover those at the end. If we don't come back to you, then we'll certainly cover that offline, and Tom and I'll come back to you separately on all of that. So I'm just going to give you a bit of a run through on tax and solicitors. I thought one of the better ways to sort of get into that is to talk about what we're calling our tax pinch points, and I'll touch on what that means again in a minute. I'll then talk about some basic planning, and then I just wanted to highlight one change that's on the horizon. If you are a business that doesn't have a 31st of March year end, there are some changes afoot. So it's something that you need to be aware of if you're affected, and you need to consider that over the next 6 or 12 months or so. So when we talk about tax pinch points, what do we mean, and why is it relevant? Well, tax pinch points really are the times in which you are suffering a more punitive rate of tax than you were previously. So some of you will be aware that that you may have a personal allowance, but above that you're paying a 20% rate of income tax. So you have a pinch point there when moving from a non-tax paying situation into a 20p rate of tax. Now these pinch points, some of them are well signposted, the higher rate of tax, but some of them are less well signposted. And I think it's worthwhile, if we're thinking about our tax planning, just to have an idea of these particular pinch points. For example, the higher rate threshold is about 50,000 when you start paying 40% income tax, which is twice the rate of 20%. But it's also the rate that, if you're impacted by this, that you have to repay your child benefit. I had a call from a client not that long ago whose wife had received a pay rise from 50 to 60,000, but they were aghast to know that, as well as paying 40% income tax and 2% national insurance, that actually they've got to repay over £2,500 worth of child benefit, giving her a 67% marginal rate of tax, which is not generally very well signposted. I think what is signposted reasonably, but again not known by a lot of people, is that when you exceed £100,000 of income, your income tax allowance is withdrawn at the rate of £1 for every £2 above that allowance, and meaning that you actually have a 60% marginal rate of income tax. At 150,000, we begin to pay 45% income tax. And for those of you, exceeding 240,000, you'll find that your ability to make tax-efficient pension savings is restricted when you go above £240,000. And I think it's important, to understand these particular pinch points and where you sit on that, particular table, so that you can actually make best use of your tax planning. And I think that, you might go back a slide, Rachel. What you might find is that, by having a clearer understanding of where you sit in that table, and you can begin to take more effective action. But I think it sort of highlights a couple of points really. One is the need to have accurate management information. A lot of tax planning involves taking action during the accounting period in which you're earning those profits. If you don't know what your profits are going to be, it's less easy to decide what action you need to take in relation to all of that. And the other point as well, I mentioned my example of the chap whose wife was aghast to find that they're in a 67% marginal rate of tax. Actually, in that particular scenario, what we did was take some money out of his business in order to give her some money to make a pension contribution to save that money. So you've got to think about how you can work, if you can, work as a family unit to get the most optimized tax position. Next slide, please, Rich. So when we talk about basic tax planning, these are some of the tools, I guess, at our disposal. And I think it's worth pointing out that the suite of available tax planning that's available to solicitors and those of us in professional practice, certainly like me, the suite of opportunities that are available for tax planning are generally more limited, it has to be said. And I think that's certainly relevant or applicable because of the fact that you can't quite take all the action you'd like unilaterally. If you're a sole business owner, you've got more freedom to restructure and to shape your income potentially in a variety of different ways, whether it's dividends, whether it's salary or some other form of reconstruction. Actually, if you're a solicitor in a solicitor's practice or a partner in accounting practice, you can't take a lot of action unilaterally. You can do some things personally, but we can't restructure the business or take other action on your own. So the options are generally more limited. And you can see top of that list is pension savings. It's something that Tom and I will bang on about. So certainly if you've spoken to us before, it will sound like broken records in relation to that, but because it's some action that you can take and that can have a huge beneficial impact on your tax planning. Gift aid, I suppose I'm not suggesting here that you give money to charity when you wouldn't otherwise do it, but certainly if you're making charitable donations, and certainly if they're not immaterial, there's a question to consider as to when is optimized to do that. Do you do it now? Do you do it now and carry it back, or do you defer into the next period? And again, it goes back to our earlier point about understanding what your income is going to be for a particular period, so you can understand how that might be best optimized. Other income, we'll talk about that in a minute, but actually what we want to talk about is if you have other assets that produce an income, we might not be able to divert our partnership profits in a way of our choosing, but what we might be able to do is structure our other investments to get a more optimized tax position. And we're going to talk about partnership expenses and possibly the use of capital allowances in relation to cars. So pension savings, just a simple reminder really that as to why Tom and I bang on about pension savings. And this is just an example of someone, maybe they have 100,000 of basic profit share, but actually for a particular period they have a £10,000 additional profit share. And what they'll find is that because of this marginal rate that I've referred to, that they end up paying 60p in the pound, leaving them with £4,000 in their pocket, which less than half. It's astonishing. But I think the alternative potentially is for them to make a pension contribution. And whilst they then have zero tax in their pocket, zero cash in their pocket at that point, because it's tied up in our pension scheme, their balance sheet is improved significantly because what they will have is £10,000 in their pension scheme. So that's why, fundamentally, Tom and I were talking to solicitors and those in professional practice around the value of pension savings, and particularly those around those marginal pinch points, as I've referred to. There's a huge amount of tax available to be used in a more beneficial way. And again, just a couple of examples there of what we're talking about when we talk about tax planning. We're not trying to talk about doing something very different, but we're trying to often talk about doing things in a more organised way, for better effect. And you can see in our top example there that we are paying 30,000 in total in pension contributions over 2 accounting periods, over 2 tax years, I should say. But by allocating them slightly differently, that we actually get an improved outcome. And it's not always possible to achieve that, as we all know. Profits and cash are very different things, but where you're able to do so, it's possible to get a more optimized result here. And you can see by accelerating some of the pension savings that we give ourselves in that example, a £5,000 uplift, and actually on an average earnings of 110,000 in that period. It's not an irrelevant return, just for organising things slightly differently. And in our bottom example, I guess the difference is far greater. But again, we're just talking about doing what we're going to do, but doing it on slightly different dates if we're able to do so. And I think it probably is worth pointing out, when we talked about the suite of opportunities available for solicitors, when we talk about those in professional practice, we're not able to take all action unilaterally. And certainly when it comes to the distribution of funds to put yourself in a position to make pension contributions, that is also probably a partnership decision, or you can't act unilaterally. But in this particular example here, in our bottom example, by making a contribution simply a few days differently, that you actually improve your balance sheet by £16,000 in that example. So around those marginal rates, and for higher earners, the differences can be very stark in certain scenarios. So worth understanding that fully. Transfer of income producing assets. If you're a high earner, say, and you've got other income producing assets, are there ways of restructuring what you own to get a better tax result? So that might involve owning things jointly, with a spouse or civil partner, entering into some sort of partnership with that person, or even transferring those assets to a limited company. And I think we've got an example there of a buy-to-let property owned by a higher rate taxpayer who has a non-earning spouse. And in our example, what we're doing here is we're transferring, in this case, 1% interest in the property. But the tax rules say that, as a husband and wife, in the particular example, that if the property is owned in any ratio jointly, then the income will always be split 50-50. And so actually what you do in that scenario is you reduce your tax bill by half in doing that. So you could certainly also do something called a Form 17 election and actually tax it 99.1 if you like to in that scenario. But then we bring other issues into play in relation to things like stamp duty, land tax, certainly if the property has a debt on it. But if you've got significant income producing other assets and you are a high earner, are there ways of getting a better tax outcome by looking at joint ownership or partnership, or potentially even a limited company? And in terms of things like expenses, I've got an example here of someone buying a Porsche, and to the extent that they use that in their business, are we able to make a capital allowances claim in respect of that vehicle? Now the allowance is given on things like cars, is not very, there's not a lot, but what you will find is that if you dispose of that vehicle and you crystallise what's called a balancing allowance, that we're able to claim the value of that allowance multiplied by the amount of business use. So again, in that example, actually there's a significant tax saved potentially for making really an expenses claim in our partnership return in relation to the business use of that particular vehicle. Now, partnerships will operate in a very different way, and actually there may be other arrangements that are in place for you at the moment in terms of mileage claims and things like that. And of course, in a practice, you'll have multiple people in multiple situations, so it's not always possible to accommodate everyone in a way that is everyone feeling being treated equitably. But certainly, are you getting the most out of the expenses that you're incurring, including for things like cars? Got to be something worth thinking about, I would say. And then finally, just on basis period reform, some will be familiar with the idea that that the government is making tax digital and the need to report information quarterly. And this becomes more challenging to do things live when you have accounting periods that aren't the 31st of March, because the current regime of assessment is that you're paying tax on the profits that end in the tax year. For the accounting period that ends in the tax year. And so there's a proposal that that will change. And actually what we'll find, if the rules are implemented in the way that they've been envisaged, that actually you'll find that there are some winners and losers in terms of what is assessed to tax. If you find it difficult today to get a handle on what you think your profit share is for a particular period, if we layer these new rules that are coming in possibly 2023, 24, across that, then it will become even harder to do that. And so I think if you're a business that doesn't have a 31st of March year end, you need to look at these rules now and see how you're going to be impacted. And it's possible that you might choose to make those changes to it to a March year end in advance of doing that. But again, there'll be some winners and losers in all of that. But yeah, you really need to be on top of that change to see how you're going to be impacted. And if I go back to the pinch points earlier on, trying to identify exactly where you will fall in that table for a non-March year end with these changes becomes extremely, extremely difficult to manage. So you need to get on top of that as soon as you possibly can. So it's really a whirlwind stop on some of the tax planning that you might undertake as a solicitor. And I think Tom, I think it's going to expand a bit on that and talk about some of the other opportunities that are available more widely.
Thank you, David, and good afternoon, everybody. Yeah, indeed, I'll add some detail to some of those points and look at some different options individuals within the legal sector could take. So, looking at pensions as the largest area, as touched on by David. So, just to highlight some of the areas to be aware of. Pensions, of course, very attractive for four main reasons. The most immediate of those four is the income tax relief that's granted at marginal rates on contributions. So for higher earners, such as solicitor partners, you know, can be a powerful effect on the overall tax calculation. Again, in the longer term, the exemption from inheritance tax, the effective exemption from inheritance tax, has made modern pensions probably the number one device for estate planning in the modern world as well, in the UK certainly. But we need to take care in three areas. Obviously, because of the generosity of the tax rules, there are some caps and limits in place. So we have an annual funding limit called the annual allowance, and this is linked to say that basically you can have tax relievable contributions up to and including for your net relevant earnings, your earned income. So the general allowance is 40,000 a year, but in 2015, as an offshoot of the austerity drive, the Treasury brought in a tapering effect for higher earners. And luckily, in the last couple of years, to assuage the public sector, it's been increased. You know, that's good news. So it was 150. It now kicks in at 240,000, where you would begin losing allowance, much like the personal allowance loss David mentioned, on a 1-for-2 basis, and that would basically, you can be tapered all the way down to 4,000 allowance once your income is at 312,000. So being aware of the level of pension contributions, again coming back to that expected profits for the year, and really some proactivity on those amounts is required. Otherwise, when David or somebody similar puts your tax return in, the government will levy an annual allowance tax charge, which will basically take the relief back if you've over contributed. Now, some people would argue you're still getting the other three benefits of having the capital in the pension. So some people would argue they would still take the deal. But obviously, we would like to have all four of the advantages rather than just three. So something to be closely watched. There's a lifetime limit on pension funding as well, known as the lifetime allowance. Moved down between 2008 and the latter part of the last decade, be frozen to 2025. It currently stands at 1,070,000 and will increase with CPI beyond that. Now, key thing here is if anybody, lots of people have a life partner of some kind. It obviously is a per person allowance. So where that sits outside of inheritance tax, you know, there's a couple of million there to be used. If it's not all to be spent in retirement, can we use the lifetime allowance of the lower earning partner, life partner in this regard? Because there's no inheritance tax or tax issues on interspousal gifts. So of course you need net relevant earnings to support contributions, but in terms of actually funding them, then you know you can be proactive between spouses, deploying that capital to make use of pension allowances annually and lifetime allowance. Finally, carry forward allows us to that annual allowance, that because the government are aware that people's earnings fluctuate, and they may have, you know, costing pressures at certain times. You're allowed to you look at a 4-year basis for pension contributions, the previous 3 tax years and the current, and this allows catch-up contributions basically to help us maximise. So going back to David's examples, you know, it allows us to be proactive on the amounts contributed by tax year to optimise the amounts saved. So we're not constrained to that single tax year. It is a reasonably complex calculation, so it's probably something that a financial planner should help you with. Moving on, Rachel, thank you. So partners are not employees, so they tend to step outside of the there's an auto enrolment compliant workplace pension scheme for the staff of a practice. The partners of a practice are not constrained to that narrow framework. Are usually able to do their own pension planning at decent levels. So they have the whole market to choose from, and they can achieve a much more tailored strategy to their investment preferences, or indeed the outcomes they're seeking. Good example of this might be somebody involved in property law, might be particularly comfortable or interested in the property asset class rather than traditional stocks and shares. It is possible with certain kinds of pensions to own commercial property for rent, agricultural land, general land for development. So to step outside that auto enrolment framework and embrace the wider options that are available. Next one, Rachel, please. So moving away from pensions now, so just thinking about, are we ever a level where perhaps we've done all the pension planning we are able or prepared to do. There may still be some surplus income, or there's some savings that we want to make over the medium term rather than all the way to retirement. So for medium term saving, the ISA allowance really is quite powerful if used in a progressive manner. The allowances are a lot higher than they used to be, and just for confirmation, they are currently sat at 20,000 for an adult and up to 9,000 per child. You have a choice of investing in stocks and shares. The newest one is something called innovative finance. This is basically loans, or the most popular, overused, is the cash ISA. If you think about a couple over a 10-year period, it's the ability to save 400,000 over a 10-year period, and you can invest that at any level of risk, with a really wide choice of investments globally. No direct property allowed, but that's it's a really powerful wealth accumulator for medium-term savings, and obviously there's no tax relief on the way in, but once the funds are in there, there's no capital gains on growth, and there's no income tax on withdrawal. So a pound needed to be spent costs you £1 out of the ISA, which makes it last longer. Investment bonds written on a life assurance contract. This is a way for higher earners to invest lump sums to take a level of income out of them, profits if you like, on a tax deferred basis. So you can have up to 5% per annum on a tax deferred basis of the original sum. And the idea, so obviously that lasts 20 years. The idea of this is that you draw that income while you're a higher or additional rate taxpayer, and perhaps crystallise that gain post-retirement when you've got more chance of being a basic rate taxpayer again. With the help of some tax planning, crystallise that chargeable gain in your year of choosing. So again, another option there for surplus income on a non-pension basis. Next one, please, Rach. Something a bit more esoteric, if you want to be a bit more adventurous and really target something to reduce that tax bill that you can look into the realm of venture capital investing. There's 3 schemes that are government supported to attract effectively retail investors to the venture capital market. Enterprise investment schemes, seed enterprise investment schemes, an earlier stage variant, and the more established venture capital trusts, offering a range of benefits, upfront income tax relief, 30 to 50%, which can be managed in the current year or carried back, potential deferral of capital gains, tax-free dividends, inheritance tax exemption, and tax-free gains. Not all of them feature in every of those 3, but they tend to be higher risk, less liquid investments, but obviously they do have a powerful reducer effect on income tax, and some notable successes, single companies in there. So if you really want to be proactive on tax and you've got some risk appetite, then this can be a useful tool within the tool belt on an annual basis, alongside pensions and ISAs, and the other tools that we've spoken about. Next one, Rach, please. So just covering protection. So for solicitor partners, generally you would look after your own family protection, but there are some things that can be done. So cover these off briefly. The partnership equivalent of shareholder protection, so partnership protection, provide value to the group on the death or critical illness of a partner, to provide some funding to help if there's an exit needed as a result of health. A group income protection can be taken for the partnership if there's a long-term sickness position, which can buy time. And then looking at perhaps larger practices that might have a number of salaried partners, if you're looking to improve the employee benefits scheme for them, you can put a group life scheme in for salaried partners, but not equity partners. These often good value for money and no initial underwriting, which can be helpful for salaried partners. Moving on. So everybody's circumstances and priorities will differ. We're looking for a balance to be found between retirement funding, general investment, tax planning, debt reduction, and potentially saving for children or school fees. If you are part of a couple, remember that there's 2 sets of allowances and tax bands to be utilised for optimisation. This really goes towards the overall financial plan of looking at the objectives and how best to achieve them. On a timescale point of view, looking ahead towards the end of the tax year is not that far away. Obviously, having an understanding of, as David mentioned, where profits are likely to get to is going to impact on your annual allowance and your potential pension saving. Any venture capital style investments as well, that decision is probably impacted by the level of expected earnings. If you are going to do some ISAs, then ISAs don't have carry forward, it's use it or lose it. But because they're not earnings dependent, they can be, if you're looking for the optimal outcome, obviously you put those in on the 6th of April, because then you've got 365 days of tax-free growth, rather than doing it at the end of the year. Moving on, Rach. Those are the areas I wanted to cover today. So I'd say any questions coming up, we will tackle now.
Thanks, Tom. I've got a question here about transfer of a property. I think it might be one for me, but someone's raised the question to say, if I transfer a property, is there no tax liability related to that? The potential there is a tax liability if you're moving an asset, you're disposing of an asset. Husbands and wives, civil partners, it's sort of sacred from a CGT point of view. So actually, you can transfer assets between husbands and wives or civil partners without a capital gain arising. That same relief doesn't apply to SDLT. So if there is, for example, a debt on a property, then the assumption essentially of part of that debt when you transfer part of the asset is consideration for SDLT purposes. So we've got to be mindful of the taxes that arise if we transfer those assets. And certainly if there's a property, including if there's one with debt, we have to think about the SDLT side. But I know in our example, we transferred 1% of a property, which we often find is something an action we take so that we don't have an SDLT problem, but we can move at least half of the income out in that scenario. I think that's the only question that's come up at the moment. But if any of you've got questions later on, please feel free to reach out to us. Reach out to Tom or I, and we'll come back to you as soon as we can. I think we're probably on time as well, which is a surprise for Tom and I. We're normally rabbiting on. But yeah, I think we're perhaps it leaves me just to say thanks for joining us, and hopefully you tune in next time for our third edition, possibly sometime in the new year. Thank you.